Hey everybody, Scott here. Hope your summer is wrapping up well. We are in the height of back to school season here with all seven of the girls. So, getting everybody back into sports and all those kind of things. So, it's been super busy around the household. Always, always kind of dread this time of year, to be honest. We have such a good time with all the family time in summer. It's good to get back in the routines and all that. But, it's always a little bit of like, man, it's coming to an end here. I don't know if Andrea feels the same way. I still go to work most days throughout the summer unless we're on a family vacation. But her with all seven of the kids at home, a lot of times I think it's like that Christmas song where they say mom and dad can hardly wait for school to start again. I always feel like that's how Andrea is at the end of the summer, rightfully so. Um, but hey, wanted to take a few minutes to chat with you about what's going on in the market right now. Had a pretty eventful, past couple weeks, especially this week, has been tough in the stock market. So I just wanted to share a little bit of perspective around, hey, what's going on, and then as always, try to frame it up here for the long term. So, if we look at where the market's at here since its high kind of in mid late July, it's down about 8% off of its high. And then really this week, it took a big hit about, at least I stand here recording about 5% over the past couple of days. And so that can feel like, oh my gosh, what is happening? And so, just offering a little bit of perspective, we saw the S&P 500 get hit pretty hard. One of the things I think is interesting is the tech sector has turned into such a large portion of the S&P 500 that when tech, struggles, it has a significant impact on the S&P 500. Even though the S&P 500 is, obviously 500, roughly 500 companies, that tech sector, especially the top handful of companies, can really sway it significantly based off of what's going on there. I was just reading this morning. As of this morning, Nvidia is roughly 6% of the S&P 500. I mean, that's a significant. So you got one company that's larger than 10% of the entire index of the top 500 companies in the world's largest stock market. So, when we see Nvidia, go up or down significantly, it does have a big impact on the index, and so that can lead things. I guess what I'd say there is it puts a lot of noise in the data, so to speak. First half of this year, we saw the S&P 500. If you recall this spring, I sent out like we had a streak going, the longest streak in like 100 years of the market not seeing a down day of 2% or more. And a lot of that was from tech, but then specifically even Nvidia, really riding a strong kind of upward trend, almost like as a hot streak, so to speak. So, many of the more technical experts out there would say like, hey, Nvidia and the market itself was overbought a little bit, and so it was getting a little too hot. So, again, if you remember this spring, we talked about the market tends to go real hot and then cold, and then real hot and then real cold. And so, yeah, we're seeing a downturn right now, but I mean, I would argue that it was probably due, and we, I don't want to say we welcome it, but it's very, very normal and healthy for these kind of things to happen inside of the market. Obviously, it'd be nice if it could just tick up a little bit every day forever. It's just not the way that it works. So I think that kind of step back was probably a little bit overdue with how quick we saw the market coming up here in the first half of the year. If we look at some of the tech earnings were a little bit under forecast. They were met for a lot of the companies out there, but maybe just not met as much as the street wanted them to be met. So we saw some sell off from that too. Also you have kind of a couple things looming out there, I think, with what the Fed's doing, talking about potentially pushing off interest rate cuts where people were expecting them to cut in July. And so we had like a weaker than expected job market outlook, and then the news from the Fed. So there's just kind of a handful of things going on that really, I think, put a lot of downward pressure here short term. I don't think it's any reason to panic whatsoever. The 1 month is down for the S&P 500. If we look at the 6 month, it's positive. The 1 year is positive. The 3 year is positive. The 5 year positive. So the market's been really good to us, even this year, despite the most recent downturn. It's still been good to us this year, and we're still on track to have a good year. um if we look at, hey, what are some of the things that we want to do or action we should take, you know me, I'm never going to recommend selling just because something's going down. We should sell something when we no longer believe in it. When we look at some of the data out there, the market, I'm sorry, the economy still looks like it's pretty strong. This week jobs report is a little bit of an indicator that maybe there is a little teetering of some potential pockets of recession out there. But that's also probably a good sign that what the Fed is doing with interest rates is working, and they are probably more likely to cut rates here in the future. Now, if you remember, we did add some bond holdings into our growth portfolio for the first time in some time, kind of anticipating these rate cuts. And so we should see an uptick in those when those rate cuts eventually come. And that, again, helps temper the volatility in the portfolio a little bit, but then also gives us some upside when those rate cuts eventually come. Now, one thing I want to remind you is that when rate cuts come, rate cuts are generally good for the economy, which long term is good for the market. But typically, what we see when rates go up, and I want you to remember this because I would anticipate this to happen. I could be wrong, and I hope I'm wrong, but I would anticipate it and be ready mentally that it's going to happen. Short term, we see the market come down for a period of 6 to 12 months, not normally less than 6 months, not normally more than 12 months. But on average, the market's going to go through a downturn after a rate cut comes. We don't know when exactly, we don't know for how long exactly, which is why we don't make a bunch of irrational decisions based off of that factoid. But we know that historically, as rates have gone up, I'm sorry, as rates have calmed down, we see the market short term come down, which again is why we have that bond holding in there. We'd expect the bonds to come up and understand that the stocks might come down a little bit short term. And we'll take advantage of rebalancing like we always do there through the annual process. And then we see the market tend to grow as the economy grows from those rate cuts. Okay, so I could be and hope I'm completely wrong about that. I hope the rate cuts manifest in an immediate increase in the market, and that very well could happen. But I do want to at least share, history as a teacher. It's the best thing that I have. That hey, we would expect a short-term downturn when rate cuts happen. It always surprises people because we don't go through that cycle very often, but that is historically what happens. And then long term, it's good for the economy and for the market. So, all this to say, the all in all for the year, investments have still performed pretty well, and we are hopeful. Short term, they'll continue to perform well, and long term, definitely have that conviction that nothing going on now is really shaping our 5 to 10 year outlook and our plan. For our younger clients, if you have shares from your company come and due, if you have cash, I think it's a good time to be able to hop back in and get some of that cash to work. If you happen to be sitting on any of it, for our retired clients or close to retired clients, we have that safe bucket built for times like this. Okay. If this short-term correction, we've seen a correction happen on the NASDAQ. We're not quite there for the S&P 500, but we'll probably get there. It's very normal. We have on average one correction every year. But for our retired clients, if this correction turns into a bear market and some sort of deep recession, it's okay. We got our safe bucket built up, and our plan is built to handle these kind of scenarios. Okay. So, anyways, all that to say, I just wanted to get a little bit of information out there, let you know we got our finger on the pulse here, and are looking at the holdings in the portfolios. I wouldn't anticipate, many changes. I know in some of the more aggressive portfolios, we had some rebalancing in the spring just due to the uptick in tech. But we'll continue to watch it here. If we see a need to rebalance, we will. But as of right now, don't see any need to take any significant action in the portfolio. Just let some of the noise settle down, and then we'll kind of reassess here as things progress. So, anyways, as always, I'll have a link in here to my calendar. Feel free to hop on my calendar if you want to talk about anything or revisit your plan, whatever the case is. But yeah, just wanted to get a note out to you. On a side note, I have to tell you, today I just put my oldest daughter on our car insurance, And I could not believe, and I wish some of you more experienced clients would have told me how painful it is to get a teen driver on your insurance. Oh my goodness. It has gotten so expensive. So for some of my younger folks, be ready. If you're getting a teen driver on there, it is painful. Our insurance bill almost doubled. So, anyways, lots going on. But we're here if you need us. Give me a call if you want to talk about anything, and look forward to seeing you soon. All right, we'll talk to you soon. Thanks. Bye bye.